Welcome to the Deep Dive, the only place you need to get straight to the strategic insights, buried deep in the quarterly reports.
Right, cutting through all that noise.
Exactly. And today we are jumping into Koppers Holdings, that's ticker KOP.
KOP, correct. We're looking at their Q3 2025 earnings call.
And this was, a wild ride for anyone holding the stock.
Oh, absolutely. The results hit pre-market, and you saw this, sigh of relief. The stock bumped up over 5%.
But then the call started.
And the whole narrative just collapsed.
Right.
By the end of the day, the stock was down over 4% on pretty heavy volume.
That kind of real-time reversal tells the whole story, doesn't it? It's like you can see the market changing its mind minute by minute.
It does. You've got management running this very disciplined, transformational play. They're cutting costs. They're shedding assets.
But the market is just deeply skeptical they can pull it off while demand is so weak.
And that's our mission today, right?
Right.
To really understand that disconnect, we need to distill how management is using this catalyst program to try and build a better, higher margin Koppers, even if it means getting smaller first.
Okay, so let's start with that snapshot. The top line numbers, it was a contradiction.
A classic one. On the surface, it was what you call a double miss.
A double miss, but the profit story was totally different. Let's get the numbers out there.
Okay, so adjusted EPS, they came in at $1.21.
And consensus was what, $1.25?
$1.25. So a miss of about 3.2%. And that was down almost 12% from last year.
And the top line was even softer. Revenue was what, $485 million?
$485.3 million, yeah. Against a consensus of around 515. So that's a 6% miss.
And a 12.4% decline year over year. In a normal world, you see those two numbers, the stock goes down, period.
Which is why that initial pre-market pop was so bizarre. The life raft here, the thing everyone grabbed onto, was the margin.
Margin resilient.
Exactly.
Yeah.
Adjusted EBITDA was $70.9 million, giving them a 14.6% margin. Yeah. And that was actually up a little bit.
So the first reaction from the market was, okay, double miss. But look at the margin. The cost cuts are working. Management has this under control.
Precisely. And the stock shot up to almost $29.25.
But then people actually listened to the call.
And as the details on the segments came out, as management started explaining the depth of the issues, that relief just evaporated.
And the stock closes at $26.70. That's the skepticism kicking in.
It shows that investors love cost discipline, but they get really spooked about future growth.
Okay, so let's unpack what spooked them. Let's go segment by segment, starting with the biggest one.
Railroad Products and Services, or RUPS. Sales there were down 6% to $232.7 million.
And the headwind here is pretty clear, right?
Oh, yeah, it's persistent. It's the Class A railroads pulling back on cross-tie volumes.
These are the major carriers. And when they start buying cross-ties, that's like a car owner deciding not to change their oil. It's basic maintenance spending.
It is. And it signals intense cost pressure on their end. What's more, management said this is the second straight year of customers pulling back forecasts.
So this isn't a blip. This weakness is getting entrenched.
It seems so. It forces Koppers to manage for, a perpetually soft environment.
But profitability in the segment actually went up.
It did.
Yeah.
They drove profitability up 18%, hitting a 12.5% margin, which honestly is pretty solid given the sales drop.
And REPS isn't just about rail, right? There's a growth engine in there, too.
Yes, and this is the key bright spot, the utility pole business.
Okay.
That saw 6% volume growth, and that plays directly into the big infrastructure story, grid modernization, hardening the grid against storms.
It's a theme they really want to lean into.
Heavily.
Okay, now let's get to the segment that really seemed to cause the reversal. Performance Chemicals, PC.
Yeah, this is where the vulnerabilities were really exposed. Sales were down sharply, 18%.
18. Wow.
Down to $144.3 million. And the profit drop was severe. Adjusted EBITDA went from $40 million last year to just $26 million.
And the volume?
The volume number was staggering, down 19%.
19%. Okay, that's the red flag. What happened?
It was a double whammy. First, you have the broad residential market softness, less construction, slower remodeling.
Sure, the macro environment.
But the second part was more concerning for investors, U.S. market share loss.
So that's not just the market, that's competition.
Exactly. It suggests some of this is self-inflicted, or at least that competitors are gaining an edge.
But management had an answer for this, right? They said they're being careful not to cut too deep in PC because they want to win that share back.
They did. That's the core conflict here.
But holding an 18% margin while losing almost 20% of your volume, That feels unsustainable. Aren't
Yeah.
you just preserving a cost structure that's too big for your sales?
That's the bear case, 100%.
Yeah.
The bull case, management's case, is that PC is their premium high-margin future.
And they won't sacrifice its long-term strength for short-term savings.
Correct. The fact they did keep an 18% margin, despite everything, was by cutting controllable costs elsewhere. It shows the core product is still very profitable if they can just fix the volume problem.
The leverage is
Yeah.
enormous.
It's huge.
Okay, last segment. Carbon materials and chemicals. CM&C. This is where they're being really aggressive.
This is the best example of that intentional shrinkage strategy. Sales down 16%,
The profits were up.
but adjusted EBITDA was up from 13 million to 16 million.
How?
Asset rationalization.
Yeah.
Plain and simple. They closed the U.S. phthalic anhydride plant back in April.
Okay.
That one closure was responsible for a nearly $20 million drop in volume.
So they just lopped off almost 20 million in sales.
They did, because it was a volatile, capital-intensive product. You chose margin stability over revenue.
And they're not done.
Not at all. They're looking at shifting their whole North American operation to a single-column setup. It's a technical move, but it basically means less complexity and lower future spending.
So when you put all three pieces together, RUPS fighting headwinds but with a utility pole kicker, PC taking a painful hit to preserve its future, and CM&C getting intentionally smaller.
It all feeds directly into this big transformation program they call Catalyst.
Right.
The CEO basically said the quarter was within expectations because of Catalyst. And for you listening, it's really important to get the Catalyst isn't just one thing. It has three pillars.
Okay, so let's break them down. Pillar 1.
Cost reduction, pure and simple. Year to date, they've saved about 19 million in SG&A.
That's a huge cut, 14%.
It is, and they're on track for 40 million for the full year. That's how you expand margins when sales are falling off a cliff.
Okay, pillar 2.
Portfolio shaping. This is what we just talked about with CM&C. Pruning the low return assets, closing plants, selling off business lines.
Actively shedding revenue to improve the quality of what's left.
Exactly. And pillar 3 is capital discipline. This is all about the balance sheet and the long-term goals. 15% plus margins, consistently. Net leverage below 2.5 times. And generating over 300 million in free cash flow over the next 3 years.
And to hit that free cash flow number, you have to be ruthless on spending. We saw that in the CapEx guidance.
Oh yeah, they slashed it. 2025 guidance is now $52 to $55 million.
Down from 74 million last year.
A massive cut. And that money goes directly to the free cash flow line.
On the debt side, they're still a bit high, though. Net leverage at 3.4 times.
Still above their target, yeah. Deleveraging is still priority 1. So they're using that free cash flow for debt paydown and for share buybacks.
Right. They bought back 33 million in stock so far.
With another 71.5 million left on the authorization, it's a clear signal they think their own stock is cheap.
All of this, all these internal moves, led to their updated guidance for 2025. And this is where the market just got completely twisted up.
It's so counterintuitive.
Yep.
They trimmed the sales outlook to about 1.9 billion.
Okay, that makes sense.
They narrowed the EBITDA range a bit. But, and this is the key, they tightened and effectively raised their adjusted EPS forecast
To what?
to $4 to $4.15, which is, well above the 3.96 the street was expecting.
So let me get this straight. Sales are down 10% for the year, but they are on track to make the same earnings per share as last year.
That is the power of the Catalyst program right there. It shows they have the internal levers to pull to offset that massive cyclical weakness.
Which brings us back to the big question. Why did the stock sell off so hard? If EPS guidance is going up, what's the problem?
The problem is timing. The market is struggling to believe in the long-term promise when the short-term pain is so obvious.
Management is saying, we're building a better, less cyclical company for the future.
And the market is saying, yeah, but your volumes are falling apart right now.
You saw it in the analyst reactions, right? It was a split decision.
Completely. You had firms like Barrington Research sticking with their outperform rating, reiterating a $55 price target. They're all in on the transformation story.
But the skeptics?
The skeptics couldn't get past the immediate red flags. The market share loss in PC, the endless weakness in rail, that's what drove the selling.
So it's a classic tug of war, execution versus the external environment.
And for anyone watching Koppers, the focus has to be on the tangible proof points now. We need to see catalysts that show the plan is working.
Okay, so what are the top 2 or 3 KPIs you need to watch next quarter?
First, Sustained high teens margins in PC and CM&C. They have to prove this quarter wasn't a fluke. Second, free cash flow conversion. We need to see that CapEx cut turn into actual cash on the balance sheet.
And what about growth?
That utility pole business.
Yeah.
It has to keep growing. It needs to become the anchor for our UPS. And finally, debt. We need to see that 3.4 times leverage number start ticking down toward 3.
Got it. We should also mention they're improving operationally. Safety is way up.
Yep, recordable injury rate down over 20%. And they added a new board member, Laura Posadas, who is an expert in wood coatings.
Which signals they're serious about innovating in that key PC segment for the long haul.
It all points to a management team that is very confident in their plan, even if the market isn't there yet.
All right, let's move to the part of the show that is, and we have to say this, strictly for educational and discussion purposes. This is where we pitch an outrageous but plausible trade idea based on this deep dive.
Okay, so let's set it up. You have the sales weakness and the volume questions on one side.
The bear case.
The bear case. But on the other, you have a management team with an iron grip on the bottom line and capital deployment. And the stock's in the high 20s, miles below that $55 target some analysts have.
So the bet is that the internal controls and capital allocation will win out over the external cyclical problems.
That's the bet. We're calling it the catalyst and cash conversion long play.
Yeah.
We think EPS can grow faster than the market expects, purely from these internal actions.
Okay, what's the trade?
The idea is to buy a December 2026 $30-$40 call spread on KOP.
Okay, a call spread. Why a spread? And why so far out to December 2026?
We need time. We need time for that free cash flow generation and the rest of the share buyback to actually hit the EPS calculation.
So you're giving the story time to play out.
Exactly. And the spread limits our cost, but it still gives us significant upside. If they hit that full year guidance of over $4 a share, this stock is just fundamentally cheap right now.
And if they actually deliver on the $300 million in free cash flow and buy back the rest of those shares,
EPS will accelerate. And that combination should force the market to give it a higher multiple, which gets you to that $40 strike price pretty easily. It's a leveraged bet on operational control.
it's a compelling bet that execution can trump a tough environment.
It is. And the Q3 results prove they have the ability to execute on the bottom line.
So to sum it all up for you listening, the core takeaway here is that Koppers is a restructuring story. They're literally shrinking to get better.
And the whole debate is whether they can stabilize those volumes before the market just gives up on them.
And that brings us back to performance chemicals. Management was very clear. They are not gutting that segment because they believe they can win back that market share.
They do.
So that leaves a really provocative question for you to think about. The CEO mentioned external factors, things like home sales, remodeling activity. If those things start to finally turn positive in 2026, how quickly can Koppers capitalize? How fast can those PC volumes rebound and completely flip this narrative from a shrinking story to a growth story?
That volume inflection point, that is the whole ball game. It will determine whether this is a value trap or a really successful turnaround.
As always, please remember that everything we've talked about today is strictly for informational and educational purposes.
It is not and should not be taken as financial or investment advice. Thanks for joining us for this deep dive. We'll catch you next time.